It's Wednesday, 21st of January, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every weekday.
And today we're not just looking at the news. It feels more like we're looking at a crime scene on Dalal Street.
The crime scene is about right. The screens are just a sea of red.
The damage is significant.
Significant might be putting it mildly. I was just looking at the terminal, and this is the steepest single-day plunge we've seen in, what, 9 months?
9 months, yeah.
Yeah.
And the worst day in about 8, to be precise.
Right. And if you checked your portfolio around, say, 2:00 p.m., you probably felt that visceral urge to throw your phone into the nearest body of water. But here's the thing that makes this so bizarre. The reason for this massive sell-off in Mumbai has absolutely nothing to do with Indian economics.
Nothing. No bank failed, no policy shifted here.
It's completely external.
We're dealing with the ultimate butterfly effect, or maybe in this case, the eagle screeching effect.
So the epicenter of this financial earthquake isn't in Mumbai. It's where...
Arctic Circle.
We're talking about Greenland. And I think for a lot of our listeners, that sounds like a headline from a satire site.
It does sound absurd.
Why on earth is a real estate dispute in the Arctic crashing a portfolio in Mumbai?
Well, the geopolitical mechanics are deadly serious. U.S. President Donald Trump has decided purchasing Greenland is a strategic imperative. And he's moved from making offers to making threats.
And that's the report that drove the panic today.
Exactly. The U.S. has threatened massive tariffs on major European nations if they stand in the way.
And we aren't talking about small adjustments here. This isn't a minor slap on the wrist.
Oh, no. The specific detail that terrified the algorithms was a threat of a 200% tariff on French wine.
200%.
It was a direct targeted shot at French President Emmanuel Macron after his comments about Europe not giving in to bullies.
Okay, so let's just trace the dominoes here for everyone. You have a diplomatic row over an island of ice.
Right.
That turns into a threat of a 200% tariff. Why does that tank the Indian market?
Because markets can handle bad news. What they absolutely cannot handle is uncertainty. And they loathe trade wars.
Right.
When the U.S. threatens something like that, investors immediately price in a complete breakdown of global trade. And that triggers what we call risk-off sentiment.
Okay, let's define that for a second. Risk-off, we hear that term all the time, but what's the actual mechanism?
Sure, it's a behavioral shift. It's fear. When investors get scared, they sell assets that are seen as risky.
And emerging markets like India.
They fall right into that risky bucket, unfortunately.
Yeah.
So global funds hit the sell button on India, not because India did anything wrong, but because the world suddenly felt a lot more dangerous.
It's the interconnectivity trap. So let's look at the wreckage. Who are the biggest casualties today?
It was broad-based, but the financials took the heaviest beating. When fear spikes, high beta stocks crash the hardest.
And high beta just means they move faster, more violently than the market average, right?
Exactly. If the market sneezes, these stocks get pneumonia. Bajaj Finance was the headline loser here, crashing 4.14%.
Wow. 4% in a single day is brutal for a blue chip.
It is. And the pain was clustered. Eternal was down 3.63%.
Okay.
Sun Pharmaceutical dropped 3.33%.
Yeah.
And Bajaj Finserv, the other twin shed, 2.92%.
And it wasn't just financials.
Not at all. Even a consumer staple like Asian Paints was down 2.87%.
So you have stocks people hold for stability, like the Bajaj twins, down 3-4% in one session. That really rattles people.
It does. But amidst this sea of red, there was one very strange anomaly.
One green shoot.
The sole survivor, HDFC Bank.
Yeah.
In a market where everything else was bleeding out, it actually closed up 0.33%.
That seems completely counterintuitive. If the market is dumping financials like Bajaj, why would anyone be buying HDFC?
It's a classic flight to quality within the sector itself.
Oh.
See, when big institutions panic, they don't always cash out entirely. Sometimes they just rotate. They sell the high growth, maybe higher risk names, and park their cash in the biggest, most stable fortress they can find.
So HDFC wasn't up because of good news. It was just the safest storm shelter available.
Precisely. It's that too big to fail safety trade.
Yeah.
But beyond equities, the fear gauge, volatility, it just spiked. The entire market sentiment shifted overnight.
Well, if all that capital is fleeing equities, it has to go somewhere.
And it went exactly where you'd expect.
Commodities.
The oldest safe haven in the book. Gold and silver had a very big moment today.
How big?
Gold was up 2.43%. For a commodity, that's a massive intraday move. It scaled a fresh record high.
And
For
silver.
silver surged even more aggressively, breaking a key resistance level. The velocity of that move tells you something. Gold is pure fear. Silver is fear, plus a bet on industrial demand.
It's the Greenland hedge, basically.
It's a tale as old as time. But oil. Oil was the confused one today.
Yeah, I noticed that. Usually geopolitical tension means oil prices spike, but the signals were really mixed.
Incredibly tricky. Crude edged up, then it dipped. You have two massive conflicting forces at play.
Okay, what are they?
On one hand, a supply shock. There was a temporary output halt in Kazakhstan. That restricts supply, which should push prices up.
But on the other side.
You have the threat of a global trade war. That means slower growth, less demand for energy. So oil traders were just stuck. Do they buy the supply shortage or do they sell the demand destruction?
So they just sat on their hands.
Mostly, yes.
Okay, so while the market floor was pure chaos, actual business kept moving. We got some big corporate earnings and deal news. Let's start with United Spirits, USL.
This is probably my favorite data point of the day. USL posted solid double-digit profit growth.
Great.
But, and this is the kicker, their volumes fell, down 3.2%.
Wait, hold on. They sold less alcohol but made more money?
Significantly more. And this is proof of that premiumization trend we keep talking about. It's not just a buzzword.
So people are drinking less, but they're drinking better.
Or rather, the people who are buying are choosing the more expensive brands. They're swapping the cheap stuff for the premium labels.
Which feels like a double-edged sword. Great for USL's margins, but it suggests the lower-income consumer is really under stress.
It absolutely connects to that K-shaped recovery idea. The upper segment still has spending power. The mass market segment is tightening its belt.
Interesting. Shifting to IT. Tech usually gets hammered in a risk-off market, but the earnings were surprisingly resilient. Persistent systems.
A very strong showing. Their net profit was up 17.8% year-on-year.
That's stellar in this climate.
It is. And we also heard from the CEO of LTMindtree, Vinu Lambu, who was talking about rising demand for AI-native services.
And that's a crucial point. The fear was that AI would just replace IT jobs.
Right, that it would eat their lunch. But companies like Persistent and LTMindtree are showing that they're the ones building the kitchen. They're integrating AI, and clients are paying a premium for it. They're moving up the value chain.
Speaking of moving up, we saw some big M&A action, Wingify.
Yes, this is a proud moment for Indian SaaS. Wingify acquired its French rival, AB Tasty.
Wow. An Indian company buying European competition.
The combined entity is valued at around $500 million. It shows real confidence.
And that confidence is still there in the startup world, too. Emergent raised cash.
They did. About $70 million, and it tripled their valuation. So the funding winter is thawing, but only for the right AI companies.
Right. And finally, a big nod from the regulator, FOMP.
They received SEBI's approval for their IPO. That's going to be a massive event when it hits. It just signals that the pipeline for public markets is still robust, despite the daily volatility.
So we have a market crash, but companies are growing, buying rivals, and planning IPOs. It's a real disconnect.
And that disconnect gets even wider when you look at the macro numbers that came out.
The classic Main Street versus Wall Street divergence.
Exactly. The IMF updated their outlook today.
And what's the verdict?
They are incredibly bullish on India. They raised the FY26 growth estimate by 70 basis points to 7.3%.
70 basis points is a huge upgrade. Usually they just tweak it by 10 or 20.
It's massive. In a world that's struggling for growth, the IMF is basically saying India's engine is running hotter and better than anyone expected.
And the data on the ground seems to back that up. We got the core sector output numbers.
Right. It rose to a 4-month high of 3.7% in December.
And what's driving that?
The basics. Cement, steel, and electricity. This isn't financial engineering. This is physically building stuff. Bridges, roads, houses.
So here's the paradox. The IMF is cheering, factories are humming, but the rupee is weakening near record lows. Why? If the economy is so strong, why is the currency so weak?
It goes right back to the global capital flows we started with. The rupee isn't weak because India's economy is broken. It's weak because the US dollar is acting like a giant vacuum cleaner.
The vacuum cleaner effect.
Exactly. When you have foreign investors exiting, like today, they are selling rupees to buy dollars. Add in high U.S. bond yields.
And the capital just gets sucked out of emerging markets.
Correct. So even if your house is in perfect order, if the whole neighborhood is on fire, your property value still takes a hit. It's a capital flow problem, not a fundamental economic one.
That's a crucial distinction, a consequence of external forces, not internal rot.
Precise.
Okay. We've covered the Arctic, the markets, the factories. Let's leave Earth entirely.
I'm always happy to leave orbit.
We're heading to the innovation spotlight. And today, the James Webb Space Telescope sent us a postcard from an exoplanet called OSP-121b.
Yes. Sounds like a Star Wars droid, but it's a hot gas giant. And hostile is an understatement.
And the discovery is that astronomers watched this planet lose its atmosphere in real time for an entire orbit. That's not a snapshot. That's
a movie. That's the breakthrough. They watched a dramatic stripping of the atmosphere as it flew around its star.
So not just a small leak.
No, a torrent. Imagine a planet being flayed. Its atmosphere is being physically ripped away by the star's gravity and radiation.
Why does this matter? Aside from being incredibly cool science.
It changes our fundamental understanding of how solar systems evolve and, well, die. We're seeing the mechanics of how a gas giant could eventually be stripped down to just its bare core. It's like watching a cosmic autopsy happen live.
Puts things in perspective, doesn't it? We're worried about a 4% drop in a stock.
While an entire planet is literally evaporating into space, it reminds you that stability, whether for an atmosphere or an economy, is a very delicate balance.
And before I wrap up, I just want to circle back. A trade war brewing over Greenland, a market in fear, but a physical economy here that's accelerating. What's the takeaway?
The takeaway is to distinguish between noise and signal. The Greenland tariff threat is loud, scary noise. It hurts short-term portfolios.
But the signal?
The signal is the core sector output, the IMF upgrade. Bridges are still being built. Software is still being sold. Consumption is shifting, not stopping.
So don't panic, sell your mutual funds because of an ice island.
I wouldn't recommend making long-term decisions based on a single day of geopolitical drama. Volatility is the price you pay for admission, but growth is what you keep the ticket for.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.